Hey everyone, I'm Jeremy Sapper. This is Kitco News. Well, we're seeing some interesting shifts in the markets. Let's start with the tech side. Amazon and Google are both making headlines this morning, making huge investments in nuclear energy. Amazon is putting over $500 million into small modular reactors to power its growing data centers, with Google following suit through a partnership with Kairos Power. It's clear that these companies see nuclear as a key to meeting the demand of AI and other data-intensive technologies. But what does this mean for the future of the energy sector and the rise of AI? Meanwhile, we're keeping an eye on the lithium market, which was once to be thought oversaturated as electric vehicle demand cooled off, but now it looks like lithium may be poised for a comeback. General Motors has just announced a $625 million investment into a lithium mining operation in Nevada, that company called Lithium Americas, signaling that the industry is far from being over. Now, could this be a turning point for lithium investors? And let's not forget about precious metals. Gold is flirting with record levels again, hovering around $2,650 to $2,700 US on the spot side, while silver continues its upward trend, reaching levels near $32. Now, this comes as a weaker U.S. dollar and declining Treasury yields boost safe haven demand. But how does China's recent economic reforms and geopolitical uncertainty fit into this picture? And joining us now to break all of this down is Bill Baruch. He's the founder and president of Blue Line Futures, no stranger to this show. Thanks for being with us, Bill.
Thanks for having me on. It's always a pleasure to join you.
Let's talk about this inflation. I mean, it's still a little bit sticky. Bond yields staying around 4%. Bill, do you see any particular sectors poised for gains in this strange market environment?
Yeah, I think there's definitely a few dynamics. We're right here at the onset of earnings season. We've seen the banks put out some pretty solid reports. We own JP Morgan and Bank of America. They've moved pretty well thereafter. I think as that story continues, NII is going to be interesting going into next year. But trading activity should be a good tailwind, as well as M&A activity. Now, the other thing that we're about to see in the coming weeks is the Mag 7 earnings. And I think that's really the most important thing here. Obviously, everybody is waiting on those. And I'm seeing a big divergence. The divergence takes place with, as the market broadly has broadened out. And so you've seen the S&P, the leadership, what was with the Mag 7 hasn't been there in the past month or two. Now, I think what that means is it sets it up for a really good positive reaction to the earnings here in the coming weeks, especially the fact that earnings expectations have risen. We've seen a really large divergence from the Mag 7 relative to the S&P and the way the earnings expectations have gone. So I'm excited, especially as things get a little unloved. I like to find those areas. It's hard to say that the Mag 7's unloved right now, but maybe just a little less loved than it has been in the past.
Yeah, it makes sense. I mean, buying some haircuts here, we're obviously buying the dip. Okay, well, we're obviously seeing a lot of interest in sectors like technology. You talked about AI, even metals. But where is the biggest opportunity here in this market? I mean, what's the long-term strategy here?
I for the S&P do have a target. I look at waves. I don't put out year-end targets. I think that 6,200 is doable. Now, the market ran up a bit. I had a really tremendous closing breakout last Friday. The follow-through on Monday was short-lived after ASML's poor earnings report, which really came a day early. They should have actually pre-reported maybe weeks earlier. So it's a really interesting dynamic there. And some of the overall PC cycle is really the headwind. I don't think this deters the AI trade at all. In fact, names like Micron have continued to perform pretty well this week. So I think if you look at the AI trade, and we still like that, but also derivatives of the AI trade. Now, it doesn't have to be tech as the derivative. Power, as you mentioned, uranium and nuclear is definitely going to be something here to look at because AI needs power. These data centers need power. If you go back to last year, it only required 1% to 2% of the U.S. power. This going out to 2030, data centers will require 6 to 8% of U.S. power. So how are we going to get that power? I think if you look at names again, the nuclear story, but also natural gas. I like the midstream area of natural gas. Kinder Morgan, I think is a really great name that we continue to like, and this is actually breaking out technically.
Yeah, interesting. Okay, well, I want to switch over to the energy side, but before we do, I mean, you mentioned ASML. Obviously, it just recently missed its Q3 order expectations, but part of it was due to this slowdown in China, which make up nearly half of their revenue. And then when we add to this the new U.S. restrictions on AI chip exports to China have also caused some concerns, especially for companies relying on China growth. So you're talking about kind of the picks and shovels. Maybe there's more opportunity in that side of the AI trade?
Yeah, absolutely. I think if you look at it, ASML is more idiosyncratic. It could be a harbinger of things within Intel and some of the other names, maybe even a Samsung. But overall, I think when you look at the AI trade, names that we own at the top end of our portfolio, like NVIDIA, this does not deter us. NVIDIA, the day before yesterday was a record closing high. We like Broadcom, not only because of it in the chip space, specifically in the infrastructure, but also because things like VMware and the acquisitions that they've made and continue, I think, to improve their business. I've mentioned Micron here. High bandwidth memory makes AI and the chips more power efficient. So Micron does have that cyclical business of the PC cycle, but they also are very, very involved with that high bandwidth memory, which is going to be needed for AI.
Yeah, so much energy needed, Bill. You talked about it. I mean, uranium prices have been on a strong upward trend with this whole conversation around nuclear energy becoming kind of key in this whole, clean energy conversation. Companies like Amazon, Google, and now Microsoft are investing in small modular reactors to power these data centers. Does this signal a long-term bullish outlook for uranium?
Absolutely. I really do think it's something here that had a big move over the last year and it's settled in over the last few months. Goldman Sachs came out the note on Cameco, which is a name that we own, talking about how they're high grade assets. I think we look at stuff like that, looking at companies that are highly positioned in order to take advantage of this. And CCJ is the ticker there, and that's a name that we really like.
Okay, well, I want to talk to you a little bit about precious metals. Obviously, you're huge in that space. You obviously have a commodities fund too. I mentioned off the top, gold, silver have been performing well. Gold still hovering around $2,650, $2,700. And a recent LBMA survey showing traders expect gold to not quite hit that $3,000, according to our own Niels Christensen, but around $2,950 by the end of the year. Talk to me a little bit about the precious metals space. Is the safe haven buying, or do you think that there's bigger catalysts here?
Yeah, I think there's some really tremendous catalysts just from the monetary policy shifts that we've seen. You've seen some of this move in gold, maybe front load and front run it. But within, something we talked about a lot here at Blue Line Futures, just quite a bit. And we put on, one of my partners writes on Kitco, some of his articles up there. He's talked about it as well. Is the fact that within the first 30 days of the Fed rate cut, you see gold respond, trading 6% better. And that's historically speaking. I think some of that may be front run here, but look at days like, weeks like this as well, where the dollar might even be a little stronger and gold has continued to perform. Gold's trading right at 2,700. I look at this as a generational type breakout right now. You go back to that 2010 and 2011 run, and it's been more than a decade waiting for this thing to round out, bottom out, and then run up through 2020 as they printed all this money, all the handouts, and they showed the trajectory of what we were seeing from fiscal policy side. But gold consolidated for the last couple of years, and then it finally starts breaking out decisively out above 2,100, 2,200, and it keeps on running. From a technical standpoint, again, like I said, with my S&P target, I like to look in waves. And this wave of this breakout, this is a generational breakout in gold. I'm targeting 2,890, 2,900, and it could certainly overshoot that and see $30,000 here in the next couple of months.
Interesting. Okay, well, I wrote down the generational side of things. It could be an interesting opportunity. I mean, you just mentioned gold's close to record highs. Are investors better off looking at silver? I mean, what's your outlook here, especially with this whole demand for solar panels that we're looking at electronics continuing to rise?
Absolutely. Well, half of silver's demand, more than half of it is coming from industrial use cases. So I do like what we're seeing here in silver. It's been able to hold really well. It's actually tracked basically gold's gains, and it has had a better return on some weeks on the year than gold. It just doesn't feel that way because of a lot of the volatility that silver holds. Now, I do think that silver should be trading somewhere around $40, especially if gold gets up to 2,900. I think that's very favorable for silver to continue to follow. However, you want to see that industrial use case really bring a tailwind as well. Copper's fallen back pretty sharply over the last couple of months, And that's something that's been a headwind for silver, but silver's still hanging around its highs of the year. I think silver, as well as some of the gold miners, if you look into the mining space more on a broad basis, it kind of really reminds me of the summer of 2021 in energy, where crude oil recovered off that pandemic low and was trading at above $70. And it had a tremendous amount of momentum in the first half of 2021. But guess what? The energy names, the individual names, didn't really participate as much. I think as we see that evolve in the second half of 2021, those energy names really began to participate, and they were the best performers in the S&P in 2022. I think we're to look at something like that, where this is a bigger move here, more generationally speaking. I think this bull market is really just getting started. There's going to be ebbs and flows. There's going to be bad months, of course, but silver and the miners across gold and silver are going to start to pick up here in the coming months, and they're really going to start to show that type of breakout as well.
Great. Yeah, I mean, a lot of our viewers looking for it. Okay, well then what about the aluminum side of things? Because obviously we've seen this demand for green energy and infrastructure projects picking up. Major markets like the EU push hard on infrastructure and energy transition plans. Do you think aluminum has the same kind of upside as copper and nickel, which are more kind of often mentioned here?
Yeah, there's been a few surges in aluminum this year that quickly fizzled out, and we've used those as opportunities to position. And in our commodity fund, it's CTA. It's under Blue Creek Capital. We are long aluminum right now. We have what we consider a core position, at least at the moment. And there is some we're not the only ones getting long. There's obviously some bets long aluminum from the LME. The specs are fairly long right now. But I think if you see trade tensions evolve around the election or after the election, just as well as the use cases, in the green space, as well as data centers, aluminum is something that's continuing to see tailwinds. I think it's very, very undervalued here. So we have a really, really, upbeat view on aluminum here over the next 6 to 9 months.
Yeah. Okay. Well, we keep talking about this energy transition. Lithium has been in the headlines. I mean, lithium prices plummeted by 21% this year after dropping almost 80% last year due to what people were calling an oversupplied market. But now we're seeing these new alternative technologies, these solid state batteries that could maybe diminish the demand for lithium. Talk to me here. Is lithium still a play, or is it kind of overhyped?
We view a very positive view on lithium, just as we do aluminum right now. Now, I think the biggest thing to understand here is how, I guess there's a better way to put it. Prices were crushed here over the past couple of years in aluminum, and that's a typical commodity, bull bear cycle. I think that cycle is played out, and now what we're starting to see is some idea of a bottoming in lithium. Now, in the past month, news of China's stimulus certainly was a tailwind. I think that as technologies continue to evolve, lithium is going to have to be right there. Now, there's obviously concerns, as you mentioned, some headwinds due to the alternative batteries or potentially recycling. I don't think technology is far enough along in recycling in order to really stave off the fresh demand within the lithium space. The other part as well too, as we look at these sort of boom and bust cycles within commodities. This bottoming out, it's more about all this supply that has come online when those prices were going higher. So I think you've also seen sort of some supply deterred offline as well. So this makes a really interesting case here for lithium. And we've been starting to do a lot of due diligence for us as how we're going to invest in the space. I mean, obviously there's ETFs that cover lithium and lithium batteries. There's big names like ALB. There's also mergers and acquisitions that are going on in the space. Rio Tinto is buying assets right now as well. So I think that just as a viewer right now, what we're doing is trying to find the best way for us to get exposure, whether that be in our commodity fund, whether that be in wealth portfolios. So we like to continue to try and find new ways to bring value to our clients. And I believe that really we're right here, we're on the brink of lithium becoming a big move or really value within portfolios. So we're just trying to figure out the right way to do that.
Yeah, you mentioned it. It was kind of the flavor of the week there for a minute. And then obviously it had this big correction. Most commodities are cyclical. But just this morning it was announced General Motors just came into the market. I mean, a $625 million investment in lithium mining in Nevada with a company called Lithium Americas, obviously signaling that lithium is here to stay. No?
Absolutely. Lithium is here to stay. I think the U.S. Production of lithium, refining of lithium is certainly a story to keep a really close pulse on. There's companies that are large and small right now that are entering the space. And that's what we're really trying to do in our due diligence because, the refining of a lithium domestically could be a really attractive asset. That's something we're watching right now.
Yeah, Bill, I'm curious how much when you're looking at commodities, obviously so closely tied to China, we see China's economy somewhat, having a moment. And then there's lots of talks about a stimulus coming back into the economy in China. We know that they're huge players in the commodity space. Are you keeping a close eye on that? How much of that is the story here on the macro front?
I think they're for real. I mean, the economy has been trending very, very poorly. I think they've flushed out some pockets of the economy that they were hoping to, and now they're really looking to step in and bring positive tailwinds. I think the communication or the efforts that they announced over the past couple of weeks are real. I think it's an effort here to turn a page. And the thing about it, when you get these type of moves in the market, is you get a big chase, and then you get sort of the FOMO type move. And we've seen some of that start to come in just a little bit. So now that it's starting to come in and settle out, I think the important thing in the coming weeks is continue to see what that communication is coming from China. We've seen maybe not enough communication around policy, and that's maybe hurt some commodities like copper. It's sort of fizzled out a little bit. Some of the other names around China that have maybe run up in the past couple of weeks maybe fizzled out a little bit, but they're still trading higher than where the initial announcement was. So I think the communication is going to continue to come. That's very important here as this evolves. We are very upbeat on it. We have not owned in our wealth portfolios individual names in China like Baba or Tencent. We haven't owned those, but we did begin to buy the EEM, the Emerging Markets MSCI index here. We got that position on as of Friday, and we're starting. It's a small position, but we're starting to get our toes in here, at least to have some exposure. We don't want to look back and say we had nothing that was around and specific of China names, and this thing was up 30% next year, and the U.S. index is only up 20%. So we're trying to find things like that. That's a great index too. Taiwan Semiconductor is nearly a 10% holding in that index. You get a lot of diversification without taking just China-centric risk.
Right. Yeah. I mean, in terms of asset allocation, we've seen increasing volatility across the markets. The Fed possibly taking a more cautious stance on rate hikes. Maybe they're going to be higher for longer, much like we were talking before. In terms of portfolio allocation, I mean, it sounds like you're doing due diligence now and positioning for what 2025 holds.
Absolutely. I mean, we do model out our portfolios. We have an equity basket that I often talk about. We hold anywhere between 25 and 35 names, maybe even on the upper end of that, to 37 names sometimes. But way we try to do is outperform the S&P by overweight or underweight different sectors in the names that we own within those sectors. But as we build out the broader portfolio, a diversified 80-20 or diversified 60-40, even though rates have been pretty high, and have come down, which is bullish for owning fixed income assets and fixed income bond funds. We've still sort of continued to believe that a real asset in an alternative basket is a great way to complement the portfolio by offsetting some of the fixed income basket and having high dividend assets like mining or midstream energy or a long short fund to help offset that and having some alternative exposure to couple with the fixed income basket. I think that's really the new way to be diversifying your portfolios for the future.
Yeah, interesting. And we'll continue to look for Q4 revenue from those Meg 7 as it continues to come out. Okay, Bill, that's all the time we have, but it sucks because I wanted to talk more about lithium. So let's have you on in the next couple of months and let's do a big breakdown of that sector.
Absolutely. Looking forward to it.
Bill Baruch, founder and president of Blue Line Futures, joining us today from Chicago. Thanks, Bill. Appreciate your time as always. I'm Jeremy Safran for all of us here at Kitco News. Thank you for watching. We got great content all week long, so stay tuned, hit the subscribe button. We'll see you next time.